This video will work through question 2 from the IEB November 2023 paper 1 on company financial statements. Information relating to Mazibuko Solutions Limited. Mazibuko Solutions Limited is a South African listed company with an authorized share capital of 4 million ordinary shares. It's always a good idea to highlight what your authorized share capital is because you never know when you might need it and you want it to be easy to refer back to. They sell and service alternative energy components to the public. Also a good idea to make a note of what you actually do. They add a standard markup of 150% on the cost of all goods. Now that I'm going to want to definitely make a note of. You can either use your calculation triangle or you can actually go and put it straight into the statement of income if there is one. We'll see that in a minute. Their latest financial year end is 28th of February 2023. Before we go on and get any other information, let's go and see what is required, because then we can take the information step by step and use it as it's given to us. 2.1 asks us to analyze the repurchase of shares by completing the following. Now, obviously, at this stage, we don't have any amounts, but we should know what accounts are involved. When you're rebuying shares, obviously, there's an amount that's going to need to come out of share capital. Share capital is an equity account, and so it would generally have a credit balance. So for the repurchase, you would need to debit the share capital account. So one of the accounts to be debited will be your share capital. Always a good idea actually to specify it as ordinary share capital. Although you guys don't have to do preference shares, there are preference shares in normal businesses. And then credit obviously will be bank because you'll be paying for the shares. Now, what you need to keep in mind is that you can only take out of share capital what went into it in the first place. And when you first issued the shares, that is the price that went into share capital. When you are buying them back, chances are they might be at a higher price, and usually in your exam questions, they are, and you can't take out more. So what you'll have to do is first work out the average share price, and so that will be part of our calculation. And the way that you work out the average share price is using your share capital account, use the value of shares divided by the total quantity of shares. Once we work out the average price, you can then calculate that times the number of shares, and then you'll know what the amount is that you need to use for share capital. The rest of it will then come out of your retained earnings or retained income, which works in exactly the same way. It's also an equity account, so it would have a credit balance, and you would obviously debit it for the buyback for the extra amount over and above the average price. So the debit will be your retained earnings or retained income, and you will credit bank. They've then given us extracted balances from the financial statements on the 28th of February 2022. Note that we are doing the financial statements for 2023, as you can see over here or over here. So that means that these are beginning of the year figures. The first thing that's given is the ordinary share capital. We can use that to start our average share price calculation. Obviously, we'll need to update it with any information that we find if something happened during the year, but at least as the beginning, we can pop it in. Notice I'm putting the rand value on the top and then the number of shares at the bottom. The beginning of the year retained income balance is given. At this stage, we don't really see why we need that, so I'm not going to worry about it. We can always come back to it later if necessary. The current assets figures given, including trading stock and provision for bad debts. The provision for bad debts is another beginning of the year figure that I need to use, because remember that when we calculate our provision for bad debts at the end of the year, we need to do a comparison to the beginning of the year, and then the adjustment will go in the statement of income. So that 617750 is going to go into working brackets so that I know how to adjust it later. Current liabilities includes creditors control. Now, you might want to immediately go and pop this in creditors control, but remember that that's the beginning of the year figure. We can ignore it for now. We don't yet know why we need it. And then income received in advance for fee income will adjust my fee income, which I'm putting in the statement of income. And so I'll go to the statement of income. I will see if there's any fee income there already. You can see there is an amount entered. Now, at the beginning of the year, if there was money received in advance, it means it was received for this year. If it's this year, that means that you're going to want to add it because the money came in last year. And so we'll need to add it to the fee income that was actually received this year. The fact that they've given me additional information that I don't yet understand why I need means I want to make a little note on the side that I might need to come back to that to have a look at it later. We are then given the extracted balances or totals from the pre-adjustment trial balance for the year ended 28th of February 2023. So these are now your year-end balances that have been given. Trading stock, we don't know. Debtors control would obviously go to the receivables note, and the figure's already shown over there. Your bank would go into cash and cash equivalents, so we don't need to use it because we don't have that note. We're given the SARS income tax figure as a debit balance. Debit shows us that that means this must be an asset. The reason for that is that it's the provisional tax that we've paid to SARS during the year. And then once we calculate the actual tax at the end of the year, we'd credit it. And you may end up with either a debit or a credit balance. I like to put SARS directly into the payables and then adjust it. If your final answer ends up as a debit, you can then move it to receivables. Obviously, as it is a debit balance, you're going to put it as a minus. You're then given a loan figure. We don't have to show the loan itself, but we are going to need to use the interest and the amount probably for calculating interest later on. So we'll come back to that. Obviously, I'm highlighting here just to make things nice and easy for you to see the color coding. When you're working in your exam, you won't be. So then what I would suggest is all the items where I'm putting a squiggle, go and highlight them. It makes it much easier to find them later. And then if you're looking for information and you don't know how to work something out, go and look at all the highlighted bits, and very often you'll find exactly what you need. Creditors control has been given. And again, you can see the amount is the same as what is in my answer. Then we're given this nominal account section. All of these will go to my statement of income because all of them are my incomes and expenses. You can see sales has already been entered for you. It's always a good idea to check each one because very often something will pop up that you haven't actually thought of that they leave out, and you need to then go and adjust, like debtors allowances. Debtors allowances is one that they'll usually want you to put in yourself. Obviously, debtors allowances reduces the sales because it's the returns from customers and other credits. So we'll subtract it from sales. Fee income has already been entered for us. Consumable stores, we can see, is already there. And then ordinary share dividends. Please note that ordinary share dividends are similar to the drawings of an owner in a sole trader. It is not an expense. You would show the ordinary share dividends as part of retained income, but we don't need to do that. It does tell us that it's 27.5 cents per share, which means I can use these two figures to quickly work out how many shares were there at that point in time. So if you say 756,250 divided by the 27.5 cents, 0.275, that tells you that at this point there are 2,750,000 shares in issue. And you can actually go and compare that to your ordinary share capital, and you can see, yes, it is the same. So all good. That means there were no other extra shares issued at that point. And that would generally represent the interim dividend, because that's showing you how much has already been declared so far. So there was no change up until the interim dividend. We are then given additional information about the shares. We can see that the company issued an additional 750,000 shares of 10 Rand each on the 31st of July. So that means that the interim shares must have been issued before. If additional shares were issued at 10 Rand each, that is going to change the value of my average shares. So I will need to show that there are another 750,000 and there's another 7,500,000 on the top of my calculation over here. We're then told that the company bought back 150,000 ordinary shares and paid the estate of a deceased shareholder 1,710,000. So I can work out my average share price above by simply working out the 7.25 Rand as taking all the numbers on the top and dividing by the numbers below. I will then want to take that and multiply it by the 150,000 shares. And that will then give me an amount of 1,087,500 that would come out of the share capital. We know that 1,710,000 was the amount paid. And so therefore, if I look at the difference between that and the average share price, I can then see that the amount that I'm going to pull from retained incomes will be 622,500. Additional information and adjustments that still need to be taken into account. The telephone account for February, totaling 12,500, had been received but not yet paid. This is a nice, easy one just to warm you up into how we do these adjustments. The two accounts involved are always given in the information. Look for the clues if they're not actually given specifically. Over here, obviously, we can see telephone. That is going to be one of our accounts. So we'll go to the telephone over here. If we received it but haven't paid it, it means we'll need to add 12,500. The next clue is it's not yet paid. That means it's owing or accrued. And because telephone is an expense, it means my other account that I need to use is going to be accrued expenses. Accrued expenses is where I owe somebody else. It's a liability, and so we'll pop it in payables. It's possible that we might have other accrued expenses coming up, and that's why I've put it in working brackets. The insurance expense for the financial year amounted to 88,200. That means that that is the actual amount that needs to go into the statement of comprehensive income. If we go and look at the insurance, we can see that there's already an amount of 96,450 that's been given. We can ignore that and put 88,200 here. But we do need to consider what is the difference, because that will need to then go in as a prepaid expense, because obviously we had paid too much insurance. It's easiest to work it out over here because you can see both of the numbers. So I'm going to subtract 8250 and then use that 8250 as prepaid expenses, which obviously is an asset, receivables, because they owe us. We paid too much. But do make sure that even though you've worked out your 8250 previously, you need to bring your numbers down here, because this is probably where the marks are going to be allocated for it. Okay. The bookkeeper forgot to reverse the income received in advance at the start of the year for fee income. We actually picked that up already. So I'm going to highlight this in pink along with all of our beginning balances. And that explains why I needed to pop my 4,000 in there. That's just confirming for me that, yes, I did need to add that 4,000. Number 4. A service was done for a cash customer in February 2023. The customer showed a proof of payment statement to the technicians, but no entry was made in the books of the business. On investigation, it was discovered that the payment never went through, and Mazibuko Solutions is still owed the fee of 6,000. That means that obviously our fee income needs to get bigger by the 6,000. And at the same time, we'll show it as debtors control because they still owe the money. Number 5, the tenant miscalculated the annual increase and has overpaid the February rent by 2,500. He has asked that this be offset against his rent for March 2023. That means that the rent account amount is too much. So we need to go to the rent and say subtract 2,500. And at the same time, we'll need to go to our payables to show that we actually still owe that money. So that would be an income received in advance. The bank statement was downloaded on the 28th of February, and the following still needs to be recorded by the company. Bank charges, 2,500, and interest on current account of 12,600. One of the accounts involved will always be bank if it came from the bank statement, but we don't need to show that as we don't have a cash and cash equivalents note. Bank charges can simply be added in the statement of income, as can the interest on the current account. Interest on current account is obviously interest that we are earning, and so it'll be part of the interest income. An EFT payment of 85,000 Rand for a 4-month advertising contract, which was started on the 1st of February 2023. Because it says that this still needs to be recorded, it means that instead of removing 3 months, we're going to add the 1 month. So we're going to go to our advertising and we'll say plus 85,000 times 1 month out of the 4 that were paid, which will give me 21250. The other account involved for that one, obviously, is also bank. The loan is repaid in 8 equal annual installments. On the 1st of September 2022, the company made the first loan installment payment. The loan and repayment interest on the loan have been correctly recorded, and interest is not capitalized. So if interest has been done correctly, it means that we don't need to do any adjustment for the interest. We just need to go and have a look at our 8 equal annual installments, because one of those is going to have to be made in the current coming up year. So that means that we need to go to our trade and other payables, and we will show over here a current portion of loan. We can find the information about the loan over here that was given to us, ZZ Bank. Remember, we made a little note that we might need it to come back to it. There we can see it. We don't have to worry about the 9%, but we can use that 10,500,000, and then we multiply it by 1 out of. Now be careful here. Yes, it's 8 annual installments, but one of those has already been made. Look carefully at the wording. On the 1st of September 2022, the first loan installment was made. So that means that there are only 7 installments that still need to be made. And so you'd need to work out the current portion as just 1/7, not 1/8 of the total loan amount. A debtor claimed that a 5 kVA model had been installed and he had been charged for an 8 kVA. It was agreed to grant him an allowance of 9,500. We'll need to remove that from sales and obviously also from our debtors in the trade and other receivables note. In addition, we also need to take into account the cost. The reason for that is that if you'd been incorrectly invoiced, it means that the cost price that we would have recorded would also have been incorrect. We'll calculate that by simply saying the 9,500 times, and now you can see why it's nice to have my percentages from the markup over here. I'm looking for the 100 and I've got the 250. So that's how you're going to work out the cost of 3,800 that you will subtract. Of course, the other account for that is going to be your inventory. And so we would want to add that to our trading inventories. We don't have any information to start with, though. So in fact, there's probably going to be another way that we'll need to work it out. But normally what you would do is you would simply say plus the 3,800 here, and it's not going to do you any harm to just add it in. You can ignore it later if you need to. Number 9, Tato Transistors, who is both a customer and a supplier, was overpaid. They requested that the debit balance of 2,000 in their creditors' ledger account be transferred to the debtors' ledger account. All that you need to do there is go and move it from the one to the other. Now, if the creditors' ledger has got a debit balance, that means it is in negative, and so you will need to add to the payables. And then when you go to the receivables, you'll probably think automatically, oh, I just need to subtract it. But you don't. Because remember, if you're moving a debit balance, a debit will increase your receivables. And so you'll add 2,000 to receivables. Provision for bad debts must be adjusted to 529,215. This is quite easy to do in the trade and other receivables note. Work out your debtors control amount as 17,646,500. And then you can see that your provision for bad debts over here will be 529,215. The reason that I've put the debtors control balance in first is simply habit. Sometimes they'll ask you to calculate a percentage of the debtors instead of telling you what the final amount is. And if that was the case, you would then use debtors to go and calculate a percentage for the provision. In this case, you don't need to do it though, so don't worry. When you have a look at it now, you can see that your provision is actually going to be reduced because it has gotten smaller. So your provision is going to actually change, and you're going to need to show that amount that you subtract as a provision for bad debts adjustment. You can show it over here because it's easy to calculate, but do make sure that you show that 88535 with its workings in the statement of income. Because the provision is getting smaller, it means that the income is, or the provision is actually going to be an income, not an expense. Also make sure that you do write the word adjustment at the end of this, just so that you don't confuse it with the negative asset provision. You're trying to show that it's the adjustment income. Show your workings over here, the 617,750 minus the 589,215 to get your answer of 88535. The following financial indicators were calculated on the 28th of February 2022. Always watch your dates very, very carefully. 22 was last year, which means it's the beginning of this year. We're given a current ratio and an asset test ratio. When you're given both of them, then it's very easy to work out inventory as the difference, because remember that the difference between those two ratios is the fact that asset test excludes inventory. So if you look at the difference between the figures, you can see that inventory represents 1,1 compared to your current liabilities. Remember that we were given the current liabilities back at the beginning here with this information. So if we know that current liabilities is 1, it means my trading stock will be 1,1. So I can now go and take that information and say inventories is going to be, ignore my 3,800 because I'm working it out a different way. And I'm going to show the current liabilities of 36,500,000, and I'll just say times 1,1, which would give me an amount of 40,150,000 as the amount of inventory at the beginning. Sometimes it's useful maybe to just make a note there that that's the beginning figure, because obviously we're looking for the end of the year. The next piece of information that we've got is that the net movement of stock, considering all purchases, sales, and returns, resulted in the opening balance being increased by 4.5 million before the end of the year stock taking. So that means that we're going to add that to this beginning figure that we've just calculated. The trading stock deficit for the year was 2,125,000. That would obviously need to be subtracted from the inventory to get the correct inventory figure. And please remember, there's always 2 accounts involved for a transaction. When you're recording a trading stock deficit, the other account will obviously be here in your statement of income. You'll simply show trading stock deficit, and you don't even have to calculate it this time because it's been done for you. It was then discovered that an employee had stolen 15,000 rands worth of diesel fuel, which is consumable stores, in February. This was not insured and has not yet been recorded. At the moment, we don't have consumable stores as an inventory amount because we've been recording it as an expense. It means that we're going to need to take that 15,000 out of consumable stores because we didn't actually use it. But it will still be an expense. We'll want to add a new expense for loss due to theft. The exact wording doesn't really matter as long as you make sure that you write something relating to a stock loss. At the same time, we can go and look at the physical stock count on the 28th of February. It's shown that there was 23,000 worth of consumable stores on hand. That means that consumable stores will also reduce by the 23,000 because you didn't use it up. We'll take that 23,000 and put it here as part of my inventory as the final amount. We then know that income tax is calculated at 30% of the profits. We can now go to the statement of income. And over here, what I would do is I would simply put a 30%. We can calculate it because the amount has been given, the 10,800,000. And so you'll work it out as 3,240,000 simply by multiplying by 30%. I like to get into the habit of putting the 30% there because sometimes you'll have to work out the calculations yourself, and you can only do that later when you're doing all your adding and totaling. And then having the 30% there means you can easily go and work it out when you've got enough information. So that is the income tax for the year. Obviously, we need to also have another account involved. Tax is the one side. The other side is going to be your payables, SARS, because you obviously owe that amount to SARS. And the last adjustment says that on the 28th of February, the company declared a final dividend of 30 cents on all the shares in issue. Remember that we did go and work out how many shares were in issue at the beginning of the question. Over here, we had a total quantity. So that is the number of shares that we'll need to use to work out what my final dividend is going to be. I don't have to show dividends anywhere other than in trade and other payables as shareholders for dividends, because please note the dividends do not go on the statement of income. They're just like drawings. And so instead they would go into the retained earnings note, which you don't have to show. So instead, we're going to have shareholders for dividends in our payables note. And we'd work that out as the 30 cents as that has been given, times, and then you work out your number of shares, which is the 2,750,000, plus the 750,000 that you issued. But keep in mind, there was also a buyback of 150,000 shares that you want to take into account as well. And you'll see that over here where you were working out the 150,000 that you were doing as a buyback. So don't forget about that. Once you've done that, you've used all of the information, and now we can go and simply do all of our adding and subtracting and totaling. Your sales figure should come to 78,247,250. Your cost of sales must be shown in brackets or you'll lose the mark, and that is 31,456,200, which would then give you a gross profit of 46,791,050. Don't worry about the percentages here, because remember that sometimes there'll be adjustments and things that would have thrown it off. The reason we had the percentages was simply so that we could do the calculation from the 9,500 to get the 3,800 in my sales and cost of sales. Your fee income should give you a total of 1,150,000. Your rent income comes out as 136,500. Your provision for bad debts adjustment has already been shown. Telephone 145,100. You've already worked out your shown your insurance figure. That was a given figure. Bank charges you'll calculate as 30,000. Advertising, you can work out as 252,250. Consumable stores, you'll have 261,000. Luckily, you don't need to calculate the subtotals, which is quite nice because it saves you quite a bit of time. Your interest income, you'll need to show as 363,800. And then at the bottom, you can work out your net profit after tax by obviously taking your profit before tax and subtracting the tax to get 7,560,000. Alternatively, you could actually do it from the 10,800,000 by simply working out 70%. In your inventory note, your trading inventories will come in at 42,525,000. In your trade and other receivables, your prepaid expenses will be shown here as 72,000. Now notice that there's another little star there. It's actually an extra star. There's nothing that needs to go there. Please learn not to get stressed if your answers are not going in the right places. The only thing that we do need to include is your prepaid expenses for advertising, which would actually be added on over here, the 21250. Sorry, I forgot to put that in earlier. That comes from the adjustment with the, in fact, let me show it in the purple. It came in from there. So you can show them as two separate lines, having two prepaid expenses, one for insurance and one for advertising, or you can combine them. It doesn't matter. Don't let an extra line throw you out. Your trade and other payables. Your trade creditors should be 48,422,000. Income received in advance will obviously be 6,500. Your SARS income tax comes in as 940,000. Remember that this is where if it ended up being a minus, I would simply move it up. And that's why having an extra space in the receivables is quite nice, just in case I needed to do that. Obviously, accrued expenses is 12,500. Current portion of loan we've got, shareholders for dividends, you can then go and calculate as 1,005,000. And you're finished. Good luck.